This is being recorded, you guys, and of course, here we go again. Watch this again relatively soon after, because my rules are specific to each strategy. Whereas everybody else out there is just going to tell you how to build it. They aren't going to give you specific rules to increase your probabilities, when you need to put this on, where the strikes are, your deltas for that matter. All of that stuff we're going to go over in this. I'm not just going to say you do a straddle and define the risk necessarily. All right. But let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading since college with some money I had earned, and then after graduating with a finance degree, moved straight up to Chicago and started working on the floor of the Board of Trade. Never filled out or built a resume, and traded all products in just about all market conditions, even options on all these products. A couple of things, this last thing really, any opinions, news, research, and analysis, other information contained here should be construed as general market commentary and not investment advice. You guys, I don't know your risk parameters. I don't know what's in your portfolio. So I do not want to be one to give you advice because I don't know if it's appropriate for you. All right. Also, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. You can follow me on Twitter at Wolfman's blog, or our parent company at Pro Trader Strat for all kinds of market snark and or wisdom. Probably more snark from me. All right, the short iron butterfly. This is a great strategy for range bound underlyings. Okay, something that's had some high implied volatility for whatever reason. Maybe it's just the entire complex, the entire stock area is seeing high implied volatility, but we see this one as being a little bit more range bound. And then we can take advantage of that volatility collapse. Once it comes into a specific range bound area, that volatility will come out. That's a product of a stock just kind of slowing down and having less volatility, right? Volatility is when we have the wild swings. Well, if you've had those wild swings and it starts settling down, this is the perfect opportunity to jump into something like this. So a couple of things to go over real quick, just to put your brain around what an iron butterfly is. Really, all it is a short call spread and a short put spread kind of jammed together, with both short strikes being the same strike. Or you could look at it as a straddle, where a straddle has the same strikes, right? You're short if the underlying is trading 100 and you're short the 100 calls and short the 100 puts, all right, with defined risk. So that would be the short straddle with defined risk. That's the way I look at it. It's a short straddle because that's how I like to build it out. Start out with the short straddle, come up with the defined risk aspect that fits my rules on how much we need to collect to do this strategy. Okay. Online, they're just going to tell you, you sell the two at the money, call and, or they at the money, call and put, and then define that risk. They're not going to give you the strike location that is optimal for something like this, which is what we're going to do right here. So some of our essentials to success would, like, we have an idea of an underlying that we think is going to be range bound. We already have that mental picture. Well, and we're thinking the iron butterfly is the one that we want because it's going to be range bound. It's going to give us a lot of a big collection of money because we're selling those at the monies. But one thing we have to know is, are we picking the right environment for this underlying? We've got the underlying. We believe it's going to be in a range bound, but is it appropriate? Well, we need high implied volatility percent for this. And high implied volatility for an underlying, we're not talking about the VIX. If we look at the VIX, we can look at that and we can see where volatility is. This isn't what we're looking for when we're trading options necessarily. Obviously when volatility is way up here, it's a pick 'em on all of these over here because they're all going to have really high implied volatility for the most part. But what I'm talking about is the implied volatility for a particular underlying. Let's just pick IBM, for example. What we're doing here, each stock has its own implied volatility percent, which means a stock will have a range, just like it does with the pricing model. You can see where IBM has a tendency to get a little overdone at the upside at about 150 and way oversold at around $100. Okay, I can remember trading IBM back in college and it was trading $100. It was a high of $100 back then, but it would toggle back and forth. So each stock, like say a tech stock, is going to have a tendency to have higher volatility, just this number over here. But what we're looking for is this underlying volatility in relation to where it's gone in the past. So what we would do is we have a numerator and a denominator. We take the sum in the numerator and divide it by the sum in the denominator. Well, in the numerator, the sum we're looking for is the current implied volatility, which is 26, and you subtract that from the low, which is 10. So 26 minus 10 in the numerator is 16. And we take 16 and divide it from the high minus the low, which is 30, right? So 40 minus 10 is 30. So 16 divided by 30 is very close to an IV percent of 53, just slightly higher than 50%, right? So that gives us an idea, our IV percent. Now, for this particular stock, the IV percent that we're looking for is above 50. So when we do that math, or you have it on the watch list, we have this code that you can throw in there. You can also, if you're on TD Ameritrade, they throw it right down at the bottom here for our IV percent. So it gives you an idea of if it's above 50, that's when we're selling premium on this strategy, okay? And if it's an ETF, my rule is above 30, okay? Because an ETF is a basket of goods, and those basket of goods usually have a tendency to meld out their volatilities, okay? So an IV percent of above 50 for the iron butterfly, or if it's an ETF, above 30, okay? That's what we're looking for. Because then we know when we're looking at this chart that when volatility gets really high, it has a tendency to come out. That's what we want. Remember, I wanted that volatility crush. I want the volatility to come out of this market while I'm in it. And right now, it's above 50. We could expect it to come out. If there's a binary event in the option contract I'm looking for, I don't want to set this strategy up in that, right? I have different rules for earnings, and this wouldn't fit that rule because we're doing it well too far in advance. But having said that, if it's a clean month, meaning there's no binary event in there, and if you're using, say, the banks or something like that, you know, an FOMC like we had yesterday could affect those types of instruments, especially bonds or, you know, TLT and things like that. We'll see volatility expand in and around those types of events. That's a binary event for the treasuries, is the FOMC. Binary event for IBM would be an earnings, okay? You know, if it's Eli Lilly or something like that, you could see their earnings as a binary event, but a drug trial will really send the volatility even higher for a drug company than even their earnings, okay? Because that is a really big unknown, all right? So keep your eyes out for that as well when you're trading these. So for the right environment, we need to have high implied volatility percent to do the iron butterfly, okay? And the reason why, not only will it allow us to set this strategy up for a higher probability of success, this is going to show you how it's a higher probability of success, actually. So you can see when EA Sports has really high implied volatility, that our wings are a little bit further than if a similar price stock like Caterpillar had low implied volatility. You can see that our wings get much further away, which increases our probabilities of success there, okay? And this is an old example, you know, just to keep in mind. This is a good example of similarly priced underlyings that have completely different implied volatilities, all right? EA in this example has high implied volatility versus Caterpillar having low implied volatility. You can see that the wings come in, lessening our probabilities of success. So set this up in really high implied volatility so that you don't fall into that pitfall of looking online and them just telling you how to do it. They're not going to talk about having set this up in high implied volatility area. And picking the right underlying. Now with this, you know, we may have the right environment. We may have the right assumption, but we need to have the right underlying. What I'm talking about with the right underlying, is it tradable? And what I talk about, is it tradable? We look at IBM and any stock over $100, we take the decimal, move it 3 ticks to the left, go to the spot month. That's the closest option, monthly option to expiration, you know, closest to about 35 days to expiration is really where we need to look for this rule. And move the decimal 3 ticks to the left. 15 cents wide is how wide these contracts should be to the bid offer during open market operations. Okay, it's not after the close because a lot of orders get canceled. All right, look at this while it's during the open market operations, because volume and open interest really dictates how tight these are. If you see a lot of volume and a lot of open interest, you know there's a lot of eyeballs in there, and that's what we want. Okay, so 15 cents wide to the bid offer on a stock, or any stock over $100, move the decimal 3 ticks to the left. That's how wide it should be. So, you know, a $300 stock like Netflix, we could say it needs to be 38 cents wide to the bid offer. You can see here it's inside of that. Okay. Any stock under $100 like Qualcomm, we're just going to go with a standard fare, should be 10 cents wide to the bid ask. All right. Any stock under $100, at least 10 cents or less to the bid ask. That will give you the indication there's a lot of open interest and volume going on in there in any given day. So if I bid 65 cents to try and buy this option, somebody's probably going to come in and offer 170s. Okay. That's what happens with free market price discovery in very liquid markets, is all of a sudden I see a better bid than I previously saw, so now I better my offer, and we try to meet in the middle. Dickering, you know, if you're trying to barter back and forth or something like that. Haggle, all right? That's kind of the same idea here, all right? So that's picking the right underlying. The duration, because we're collecting a credit, anytime you collect a credit, you want shorter duration, all right? Because we're going to have a faster decay of those options. And these are the at-the-money call-in options, which is going to be what we're using. So this is going to be a very good representation of the theta decay we see. And we can see way out here on the timeline, 98 days to expiration, there's not a whole lot of theta decay. But once we get inside 35 days to expiration, which is kind of right around where we want to set this strategy up, close to 35 days to expiration, we get all this theta decay, and that's what we want to take advantage of, that theta decay. And if we are lucky enough to have the volatility come out during this option expiration or during this option contract, what happens when volatility starts picking up, we see this red line or blue line start holding off a little bit because volatility starts pumping up the premiums, all right? And then if we get into this contract and all of a sudden the volatility comes out, well, it feels like the theta aggressively starts coming out of it, but it's really the volatility holding off the theta, and it will catch up. So if we can set it up in and around this kind of area, we will see that massive theta decay and volatility coming all out at once. So that's kind of the idea what we want here. That will give our strategy, it will make it kind of go like from this when we have high implied volatility to looking like that when the volatility comes out, which is what we want. We want that volatility to come out quickly. Herman, what can we choose the exchange market to send our trade to? You can, yes. Well, at least with TD Ameritrade, you can pick the exchange. You can, when you're in the trade area over here, let's just say I'm going to pick something. I'm going to just buy this. You can go over this says best exchange over here. You can pick the exchange you want it to specifically go to, yes, with TD Ameritrade. I don't know if everybody does, but I would suggest going to the best market and there's an algorithm in here that will auto leg it, will trade into that for you, okay? So try and play that. I always go to the best market. Good. All right, cool. All right, picking the right strikes. Now, with picking the right strikes, what we want to try to do is in our collection to the width of the spread. So if we have a $10 wide spread, so that call spread, let's just say it's selling the 100 calls and buying the 110 calls, okay? Well, we would want, when we're selling those, the at the monies, we want that collection to be at least 50% the width of the strike. So if it's $10 wide from the call to the defined risk call, then we would want to have a collection of at least $5 for that trade, okay? And I'll build that out here in a minute. An easier way to look at it when you sell that straddle, just think, all right, the first place I'm going to start looking to define this risk is 2 times that collection, okay? It's going to be a little bit farther out than what we want, but it gives us a great starting point. So if we sell that straddle and we collect $10, the first thing we're going to do is look at $10 wide, or sorry, $20 wide to define that risk, okay? And we'll build that out here in just a second as we're getting closer to it. And knowing our exit strategy before we enter this trade. I'm usually looking to, with the iron butterfly, only collecting about 30% of max profit. So in that example, I said we were collecting $10. I'd only be looking to get out at a 30% or 30% of that max profit. So about $3, okay? The reason why is because the iron butterfly, we get a big fat credit for it. We don't have to take a full boat on it. What's the likelihood it's going to stay right here for the next 28 days too, right? Not a great probability of that. So get out a little bit earlier to be successful. And one of those things I like to look at, if I'm only in this iron butterfly for 10 days and I'm at 10% of max profit because we've collected such a fat credit for it, 10 days in it is going to still give us a nice reward, all right? You're in it for 15 days and you're at 20% of max profit, or even 25%, cover it, okay? Anything greater than these numbers is where you want to, if you're in 25 days and you're at 30% of max profit, cover it. With the iron butterfly, you aren't really ever going to get that max profit because you would have to nail the number. Like the XYZ stock, you're doing the 100 short strikes, right? That XYZ stock has to finish the last day at 100 even, not even 101 to get that full boat. It's not going to happen, right? So get out early, especially with this strategy. You're getting a nice big credit. You know, one thing we used to say on the floor, bulls make money, bears make money, pigs get slaughtered. And with this one, you can get slaughtered if you're trying to squeeze this out for the max profit, all right? It's just not going to happen. You're going to be sadly disappointed, all right? Max profit is, though, the net premium received minus commissions. It has to nail the number, though. Like I said, I don't think I've ever seen it happen, okay? Max loss is limited, but it's the spread, all right? It's the long call minus the short call minus the net premium, or because the market can't go up and down at the same time, right? It's the short put minus the long put minus the premium. So it's the width of the spread minus the premium received. Remember, we're looking to collect about 50% of the width of the spread. So our risk reward is basically 50-50 on this, right? Then our break even is going to be on the upside, our short call strike plus that premium received. So when we were talking about our example of the 100 strike, we collected $5, our break even would be at the 105 on the upside. And if we sold the 100 puts, our break even to the downside would have been 95, okay? I hear you, Rick. I love having you back. You keep me on my toes. You were gone for a little while, and we're not quite to the offer yet. So Rick threw me off my game. I meant to pull up this trade and I hit my change window. So let's go through a couple of examples here where you guys throw out some examples. We want high implied volatility percent, so slim pickings. We can pick something that is an ETF. You know, I like to do a little bit more premium than this. This is also 3 times leveraged. I think I would stay away from something like that. But an ETF we could look at is GDXJ if we thought it was going to settle down around here. It's got implied volatility percent of above 30. So let's just go ahead and look at that. So our rules, right? We're going to go through those. First one, is it the right environment? We've already discerned that. It's an ETF. It's got above 30. That fits the rule. We could do the math over here. I'm not going to go through all of that right now. Herman's asking, iron butterflies or iron condor, which is better, the ups and the downs? Well, iron condor has a higher probability of success because you're going to be able to get way out there past the 1 standard deviation on that. The iron butterfly is going to give you a lot bigger credit. For instance, if you covered this iron butterfly at a 30% of max profit, you are probably going to collect a lot more than you would with the iron condor at 50% of max profit, okay, for my rules. So this one has a lower probability of success than the iron condor, but you also are getting you're getting paid a lot more for taking on that risk, okay, which is why I want you to get out a little bit earlier because it's a lower probability of success. If you can beat that, beat it, right? Does that make sense for you? Okay. So it's going to kind of depend. If you're pretty sure, like with me, with GDXJ, I think it's going to be stuck right around here, around the 13 handle in gold, 1300 in gold. I think it's going to make GDXJ kind of stick here. We'll see volatility start to come out, kind of like what it did back in here, right? Kind of consolidated right around this point of control. That's where the most time and volume has been spent. If you guys watch my daily market commentaries where I do all my trades, talk about all my trades, talk about all this charting stuff in those, when markets get back here, you get these wild gyrations, we start settling down. That's the theory in and around the market profile. So let's go with that theory. 28 days to expiration is closest to that 35 days to expiration, right? So that's what I'm going to look at here. I also mentioned we kind of want to do this as close to delta neutral as possible. That's usually when you're doing the 50. If I sell the 33 calls, right, that gives me a negative 53 deltas. And if I sell the puts, all right, I'm selling negative 47 puts. So 2 negatives make a positive, right? So negative 53 plus 47 gives me, I'm kind of slightly negative delta here by about 6. That's not major enough for me to worry about right now, okay? I think that's as close to delta neutral as we're going to get. And I like that 33 strike there, okay? It's pretty close to this point of control. So that's what I'm going to go with there. And I am selling the 33s and selling the 33s. So I got a total collection of about $2, all right? So what did I say? Double that. I'm going to look at going $4 out. That's going to probably be too far. So let's look at it though anyway. Buy the 29s, go $4 higher. That gives me the 37s to define that risk. All right? So I got a $4 wide and just slightly less than 50%, but it's close to 40%, 40 to 50% with the strikes, what I'm looking for there. So that works out pretty darn good, right? We're happy with that. And if you notice, when you take that $1.78, add it into the 33 for our call side, right? So now our break even is going to be at $34.78. Yes, $34.78 to the upside, which gets us all the way out to almost a a 25 delta, which is pretty good. Vice versa on the downside, it's going to get us down to about that 23 delta, which is good. So and when we were doing that iron condor, our our loss would have been happening out here, but we were also only going to be collecting probably about 30 cents for this trade. Okay. So, if we only took 30% of max profit here, then we're looking at getting about a 50% or a 50-cent profit, because 30% of 178 in my head is about 50 cents. And on that other one, the iron condor, we're probably only going to be collecting about 30 cents on this one. So if you were looking at another thing to look at here, I think it was Herman, is that if you looked at the iron condor here first and you're only collecting about 25 cents, then I would have looked at the iron butterfly for this strategy to collect a nicer credit here. Okay, so if you can't fit the rules on the iron condor, then you default back to checking the iron butterfly here. Okay, and that's usually kind of what I will do as well. If I don't really love the iron condor, I'm not getting enough credit, I think that the market is going to stay well within my short strikes on the iron condor, then look for the iron butterfly. Does that make sense? All right, somebody threw up an example. I think it was Biogen? Biogen here. So let's delete this one. Biogen, $225 stock, decimal 3 ticks left, 23 cents wide to bid offer. It might be tighter than this. I haven't checked Biogen in a long time. I like to trade this stock for its earnings, and I know it has tight markets for that. Looks a little bit wide than what I'm normally used to seeing here. Let's just check the volume and open interest on it. You can see not a whole lot of open interest before today. You can see all of this volume and volume going on today is going to create a lot of open interest in and around Biogen. Big move today, causing that spike. When are their earnings? I'd like to check that out too before we get too far with Biogen. Let me find a clean chart here. So it's outside there. I mean, did they have a drug trial, or was this that thing? Did I see somebody had a drug trial that basically they were going to lose $18 million on her, or $18 billion on her? Something. Biogen scraps 2 Alzheimer drugs. This was the one I saw. Wipes out $18 billion in market value. So I don't know. Is it going to go low? I don't know if I would bet on this one staying right here, Banu. But let's, I mean, I would bypass this one right now. So yeah, I saw that headline on FinViz. If you guys watch the FinViz, it's got a lot of good news and stuff like that. That's I have no affiliation with these guys, but this is a good one for different news sources. And as a matter of fact, that Biogen thing, why aren't you wanting to come down here? Where I read that Biogen was right here on Reuters. So you can click on it and find full details on it. All right, so Biogen meets all of the other rules, I believe, especially on the, with that volatility spike today is probably a reason why those markets got really wide too. But let's look at another example. Let's look at Disney for this. Disney, what we're going to go to, and it has a clean month. Their earnings fall just outside this month, but they do have high implied volatility. So let's take advantage of it. Well, closest to the at the money, we can look at the delta to try and start it out being neutral. It's probably going to be the 109s, right? That's closest. 51.49. That's as close to delta neutral as we can get. So we sell the 109s. We're looking at the 109s. We've got $6, so let's go $12 down to the downside. So 100. Ugh. Of course, they mess us up. I'm only going to go $9. Wait, 6, so 12. That would be $14. I'm just going to go to here and buy that one. So I went $9 down to the downside, $9 to the upside just to buy it. And just slightly more than 50% of the max profit. I would have loved to have the 99s in there. I think it would have worked out perfect. But as you can see, close to 50% of the max profit on that, or sorry, the width of the spreads on that. So that's good. Slightly better. You know, I'd like to have the wings a little bit further away, but it doesn't always fit that. So let's analyze this trade. And you can see that our risk on this trade, without my other trade that I have on, is basically our reward is 533, and then our risk to the downside, because it is less than $10 wide, is less than what our profit potential is. So that's a good trade for me. And look, what we can do here is we can see what would happen is if volatility, we start adjusting this volatility down, you're going to see that our break evens start happening faster, okay? As volatility increases, you watch that purple line increases. That means our profitability is happening, right? Versus if it starts, volatility goes up, which is what we don't want to do, we could see that our profitability would be less likely, okay? So we want to get this in a high implied volatility market where we expect that volatility to come out, okay? Pretty simple. We're looking at the credit. We look at doubling that. That's where we start to define it. And if it doesn't work out, we got to go a little bit tighter in order to make that work, okay? Try and collect somewhere between or right around 50% the width of this spread. And we did that on this example. I'll do another one. Yeah. Let's look at EA Sports. I believe EA Sports has an earnings coming up in this cycle, but we're assuming it doesn't. So let's delete this one. And we believe EA Sports is going to stick around right where it's at. All the news about Apex Legend and all of that stuff is out. And we expect it to kind of settle down here until their earnings to see if Apex Legends is really what it's all cracked up to be. So selling the 104 strike, actually 105s is going to be the closest. We can see here the delta neutral is closest to delta neutral. So we're collecting $8.66. So we'll go about $16 out. So I'm going to be looking at probably the 95 strike. Oh, that's only $10 wide. So 95 strike is $10 to the 90 strike. Let's just go to the 92s. So we'll go a little bit tighter. The 92s, so that makes that 13 wide. So 13 is to the 18 on the upside. Come on. These guys aren't giving me love. All right, let's increase this, all of them. So we're going to go from the 105s to the 90s. So let me get out of these. Oops. Let me get out of those. What is that? The 92s. So sell those twice. Get out of them. Let's go to the 90s. Buy those and then go to the upside to the 20s. And we'll take that to buy. So $7. $7 wide on a $15. So that's right there. 50% of our max profit, right? And with this one, we add in 105 to the 7. So our break even is right there at around 112-ish, you know, outside of that, closer to that 25-ish delta. That's where we're looking at, where our break even is. So that's good. Can we use weeklies to get the 45 days to expiration? Yes, you can. Just make sure. You can always use weeklies. I usually use the monthlies because there is more volume and open interest going on in the monthlies. The only case that may not happen is if it was a stock like Apple or something like that and it was around an earnings event. All right, that might be a time where you see volume in those weeklies be more. But yes, you can move it out. I would probably go with 28 days right here for this one for sure, rather than going further out because we're right in that theta decay area. But I don't have a problem using weeklies. Just make sure that it meets the keys to success for it being the right underlying. In that those weeklies are going to have a tight bid ask. Does that make sense? And you can use weeklies for all of my strategies as long as it fits all of the rules, okay? All right. Perfect. All right, well, that's it. And you guys, that brings us to our offer right here. It is in the chat window. We've been talking back and forth in the questions box. Over there in that bar, you'll see a little chat thing. I just kind of added it in there. You can click on either one of these links for this deal. It's how to trade options like the Wolfman, setting up your option screens, how to look at those market profile and all of those other things right here, trading around that, income generation with options, protecting your portfolio using options. So like if you have stocks and things of that nature, I teach you how to trade around that portfolio of stocks and or your bond portfolio. Nobody trades around their bond portfolio. They just let it sit there, and you should be constantly being diligent about hedging that as well for interest rates and things of that nature. So if you're watching this on tape delay, you're going to have to pause it, punch this into your URL. But like I mentioned, if you're watching this live, which a lot of you are, go to the chat window and click on that window or click on that link there. It's a lot easier. And finally, I want to thank you guys all for participating in this. Later webinars will be drilling down on different option components when and where I find those appropriate. Again, here is the link. It's not a hot link. You'll have to pause and punch this in. If you have any questions, reach out to us anytime at 310-598-6677 or email us at trading@protraderstrategies.com. If a strategy isn't in this deal right here, call us up. We can talk to you guys and show you different tailored courses for what you're looking for, all right? If you're a newer options trader, we have stuff for you. If you are a savvy veteran trader and want to know what my rules are, we have that as well. So like I said, if you guys want to be able to sleep at night, be better traders, the best way to become a better trader is become mechanical and trade with specific rules. That's what I'm trying to do here, is teach you guys to plan your trade and then to trade your plan. Write down all of your reasons for getting into this strategy, when you're going to get out. Write that down so you stick to it. If you aren't being mechanical, you can't have any data to go back to see if what you're doing is working, all right? If you're all over the place, you don't have any consistent data, all right? So write it down so you can go back and check yourself on it, all right? That's all I got for you guys. Went pretty quick today, pretty easy. It is a great strategy for high implied volatility. When you expect it to all come out, you will see profits come in quickly with this strategy, all right? So if you can't take that, take it easy. Take care, guys. You're welcome. Appreciate all the kind words. Take care, you guys. What's that, Ted? Did you know Ron Aniri? He was partners. I didn't know him. Sorry to hear that. I'll reach out to Pete and John about reach out to them about that. Sorry to hear. Thanks, guys. Take care.